Hi guys, so today we're going to be chatting about how to invest step by step. So I've chatted about investing on and off on the channel over the years, but I figured I would make a somewhat comprehensive guide as to how to get started if you've never done it before or if you're hesitant to start. I highly recommend you start investing. However, there are a few things that you need to do beforehand that we'll chat about. And then from a technical side, I'll show you actually how to invest as well. So let's get started. Okay, so first things first, before you invest, you need to have your financial house in order, as they say. I know lots of people like to jump into things prematurely, but in order to have the best results, you should do some prep work. So the first thing that you need to do is to actually have an emergency fund. I have a video on how to get an emergency fund started, so that could be your frame of reference. But essentially, you want an emergency fund because in the event that you run into financial troubles, you don't want to have to withdraw your money from the stock market, because since we cannot predict the future, you might actually end up withdrawing money at a time when the stock market is down, which means that you have lost money. Additionally, lots of these, specifically retirement investment accounts, have penalties associated with them, and you don't want to have to incur a penalty to withdraw money when you need it emergently. So before you even think about investing, have an emergency fund in place. At minimum, you should have about 1 month set up. The other thing that you should think about doing before you start investing is to pay off your debt, specifically high interest debt. So debt that is above 6% outside, of course, a mortgage. So that includes credit cards, personal loans, student loans, etc. The only exception to this would be if you are getting a employer match on your 401 or 403b contributions. Then you want to contribute the minimum required to get that match. Usually it's a small amount of money, so 4% of your salary, for example. And you want to do that, even though Dave Ramsey does not suggest you do that, but you want to do that because that money is unrecoupable. So if you don't contribute, you don't get the money, and you cannot get the money back at a future date in time. So do the minimum and then use everything beyond that you have excess in your budget to pay off your debt. Now, in terms of investing, I suggest, and there is like an investment order that you can follow, and I actually recommend it as well, based on, there's some logistical things that we'll talk about as we go through this. But the first place that you should be looking to invest your money is in your 401k or 403b. And that is because it is pre-tax income. So that is money that you were paid before you were taxed. And by contributing to your 401k or 403b, you're lowering your tax liability, which means in theory, you should be paying less taxes. Additionally, the earnings that you make in the 401k or 403b are deferred until you take them out in retirement. In other accounts that we'll talk about, such as the taxable brokerage account, that money that you earn in that account is taxable. So you want to fund your tax advantage accounts first. Another pro of the 401k, 403b, as we just talked about, is the fact that you usually can get a company match as well. And like I said, you do not want to leave money on the table, so definitely contribute to that first. So currently, as in 2024, you can contribute up to $23,000 in your 401k or 403b. Now, if you haven't invested before, or you're just starting out in your finances, or you make an average salary, like that is a lot of money. But as I said, it is the max, so you don't have to put all of the $23,000 in there. Just any amount that you can put in there is a worthwhile investment into your future. So don't let that overwhelm you. So start with whatever you can know, and then as your salary increases, you can increase the amount that you contribute. So if you have managed to max out your 401k, 403b, then the next place that I would suggest you put money into is the HSA account. So that is a health savings account. Currently, the max for that is is $4,150 if you are single, and then if you have a family, that is doubled, so around $8,000. Another great thing about this is that it is also a pre-tax contribution, so it has all the benefits that I mentioned before. Additionally, some employers will contribute a certain amount to your HSA as well, so once again, extra money if you can get it. And a little unknown fact about HSAs is that you can, as I mentioned, invest in them. They are marketed as a, of course, health savings account, so you can use the money in there if you keep it in cash for medical expenses for the current year, future years, whatever. But if you are relatively healthy and you don't believe that you need the money, then definitely invest it. Next account to invest in would be the Roth IRA. This differs from the other accounts that I mentioned because it is a after-tax contribution. The benefit of that being that since you've already paid taxes on the money presently, you will not have to pay taxes on it in the future when you withdraw it. Now, if you manage to max out all those accounts, then that is the only time that I would consider investing in a taxable brokerage account. Now, these are the accounts that you may see people talking about regularly. So usually Robinhood has one. Every major financial firm has one as well. So Vanguard, Fidelity, Schwab, etc. will also have a taxable brokerage account as well. And you can invest depending. So all the accounts that I mentioned previously, you can buy individual stocks depending on your employer for the ones that are employer sponsored, or you can invest in mutual funds, indexes, etc. as well. The reason that the brokerage account is last up is because you always want to take advantage of any tax advantages that you can effectively, because any time you buy or sell anything in a taxable brokerage account, you will be responsible for the profit you made, as in paying taxes currently in the current tax year. Or if you earn dividends, you will have to pay taxes on that as well. Now, in terms of what to buy, so I did mention and just now about some of the things that you can buy, but we'll delve a little bit more into it, as in what I would suggest buying if you're new to investing, have never invested before, aren't really into finance, but want to set yourself up for the future and you don't want anything complicated. Like, this is what you should consider. So easy one is a target date fund. So if you believe you're gonna retire in 30 years from now, so 2054, then you would pick a target date fund that says 2054 or something to that degree. And basically these funds work by whoever is managing them changes the allocation, so the bond stock allocation and the risk year to year without you having to do anything. So in the beginning, the risk is higher, or the allocation is usually towards more stocks. And then once you get closer to retirement, the allocation is in more bonds or cash or things that are less volatile. So that is a great option. If you don't want to think about it, then target date funds are available for you. If you don't want to pick a target date fund and you just want to invest entirely in the stock market, then other options are the total stock market fund, which is basically all the US companies available on the stock market in a index or basket of funds. Another similar option would be the S&P 500 or Standard & Poor 500, which is effectively the top largest 500 US companies. So their stocks are all in this basket. The difference between the total stock market and the S&P 500, obviously one has all the stocks and one just has 500, but the S&P 500, because it has the biggest company, they usually make the most money, and therefore there is a greater chance of you making more money than if you invested in every US company. So if you would like to make more money, then the 500 is available for you. But of course, anything with high return has a higher risk. So if you don't want as much risk, but you want a decent return, then the total stock market is another option. If you want to negate your risk as the years go on, then the target date fund is an option. I would say if you're just starting out to avoid individual stocks or picking stocks, because the less diverse your stock portfolio is, the more chances that you could lose your money. So that's why I suggested those 3 funds as a good starting point, because you will have a minimum of about 500 companies if you choose any of the funds that I just mentioned. As I was saying, the level of diversity in the funds goes up. So S&P 500, least diverse, total stock market, medium diverse in terms of the funds available, and then target date fund usually has a pretty good mix of both stocks and bonds. So that is the order in terms of your risk aversion if you wanted to pick stocks based on that, which you should of course do. Now we're going to move on to actually buying some stocks. So I'll take you into my investment portfolio. So this account that I'm going to show you guys is the taxable brokerage account. As I mentioned, the retirement account or the preferred way to invest if you're just starting out. I have already set up those accounts years ago, so there really is no way for me to show you how to set them up, but effectively you usually sign up for them once you start your job. Additionally, you need to, if you have already started your job and you haven't done this yet, then you can talk to someone in HR or log into your intranet and log into the HR portion, usually where your paychecks are available, and you can set it up there. But effectively, once you set it up, you're going to be in a brokerage or a financial institution. So Fidelity is a very popular one. So you'll head into the Fidelity website. There's a portion where you can set up your contributions, and effectively you can select what percentage of your paycheck you would like to go into the account. Sometimes that is done on your employer side, so like I said, through HR, and sometimes you can set it on the actual financial institution side. So once that's set, then you can go in and put in your allocation for whatever stocks or bonds or exchange traded funds, anything like that that you want to buy. Then you can set up the allocation. To start off, if you want to make this easy, I would put 100% of the money that you're going to put into the account into one of the diversified funds that I mentioned before. So for example, the S&P 500. I will insert a screenshot of some of the information I'm talking about. Hopefully I can find it so that this actually makes sense and can kind of help guide you to where you need to go. But this can also help you as well, even though it's a different account. But the setup is basically the same, as in what you're gonna do, what you need to look out for. I'll like walk you through some of that stuff as well. Okay, so this is the taxable brokerage account, as I mentioned before. If you have already managed to set up all your other retirement accounts, if you've maxed them out, or somehow you feel that you don't need to max them out and you've come to this point, then this is an option as well. But like I said, there is a reason why this order exists, and it's usually for the best. But you know your financial situation, so you can decide what you'd like to do. Effectively, there is money in the account that you would need to transfer from, say, your bank account to this account, and you can do that by clicking a button that usually says like transfer accounts or transfer money. So let's see here. Okay, so right here it says transfer money. So you can send some money over into the account, and then it will appear here as funds available to trade. I already have some funds already set up here, but if you did not have funds set up, then you could go to the transact. It'll vary by investment firm, but effectively you want to choose what you want to do. So usually the major companies have their own funds. So Vanguard has their own funds, Fidelity has their own funds, so you can buy those directly, or you can just buy ones that are available to the general public or ones that are owned by some other company as well. So that's one option. If you already have a fund set up, then you can directly go and buy into it. So let us pick something to buy. So before you buy anything, you should get some information about what you're going to buy. That's, the financially responsible thing to do. So every fund equity asset that you're going to buy in these accounts usually has what you call a prospectus. So basically information about the stock. Vanguard does a really good job of breaking it down, and so do most major companies as well. So I'm just going to tell you a few of the things that I look out for what I'm buying. As you're going to see in a few seconds, I'm going to be buying the Vanguard Consumer Discretionary Exchange Traded Fund, so VCR, that is a ticker symbol. And here is the overview quickly. So it's an index, so basically a basket of funds like we talked about. It's a domestic stock in a specific sector, which is consumer discretionary. The expense ratio is 0.1%, and that is basically how much you're going to be charged for this company to maintain the stock for you in your name. It also has, of course, the market price, so that is the cost of a share, and today, as we're recording this, is $3.12. Also important, the rate of return. So this one just has the year to date, so since the year started, so from January of this year up until now, which is the 9th of April. So similar things are repeated there. And here they also have a risk scale, which is nice. So it's 1 to 5, I believe. So 5 is of course the most risk. And because this is mostly stocks, it usually has a higher risk than, say, bonds, which would be over here on the 1 side, or some fixed income product like a money market fund or something that pays you a steady rate of return and doesn't loan your money out, etc. So more things that are repeated that we just chatted about. Also importantly, previously we saw the year to date rate of return, but you can, if you want to go back several years, up to 10 years, you can see the rate of return as well. And there is this popular saying that the history of a stock does not predict the future of the stock. So there's that. However, it gives you a basic idea if the past were to repeat itself on the trajectory of the stock. Next up that I look out for is sometimes, depending, I like to look out for the price of the stock over time. So 52 weeks ago it was $243, and now it is at a high or close to the high, which was $314. So sometimes you can use that information to determine whether you're buying in the low portion of the stock or the high portion. So that's something to consider. Like I said, if you're just starting out, it's just best to buy the stock and ride it out for the long term, provided you are buying good stocks, like I mentioned. So target date funds, total stock market, S&P 500, etc. Other fun things, if you're starting out to know, are what exactly is in the stock. So this one, as I mentioned, is a consumer discretionary fund. So effectively things that people buy that are not necessary. Things that are necessary are usually commodities like food, toilet paper, etc., gas, things of the like. And these things, as you can see, you don't necessarily need them, but people like to spend money on them. So there's clothing, luxury goods, cars, retail in general, casinos, computers, etc. So you get a breakdown of each sector, like what percentage makes up this particular fund. I find that that's fun to know. And then also good to know is what actual stocks are in there. So you can see this one has a lot of the well-known stocks, so you can see them: Amazon, Tesla, McDonald's, Booking.com, TJ Maxx, etc. So that's important. And if you are delving a little bit more into things, you can also see the dividend rate. So this particular fund pays dividends, some do not. And then of course they have the fine print as to how the stock is put together, or the fund or index is put together, and who is managing the fund. So you can also find even more information in the other prospectus and in the reports as well. So definitely check this out before you purchase any equity. Okay, so I'm just gonna pick something random here. This is the Vanguard Consumer Discretionary Exchange Traded Fund. So click buy, and you can currently buy shares off the actual stock that you're in, or you can buy it based on the amount of money that you have. So if you don't have enough money to buy the actual share, you can buy a portion of the share, which is what I'm going to do today. So this share costs $312, but I am just going to buy $100 worth. So type in $100, and usually for this there are all these order types that you can do if you're more advanced or are looking to maximize your returns, etc. But as I said, I'm assuming you're just starting out, so you're not concerned about this. Of course, if you start to get into investing, then you can look into these different order types. So there are limit, stop, and stop limit. But we're not doing that. We're just going to buy it at the market rate, which is whatever the rate is when the market is open. Right now the market is closed because it's the afternoon. You can see the sun is setting. So whenever the market opens tomorrow, that's the rate that we're going to buy it at. And you can also set the duration as well, but it's just going to be a day order. So then tomorrow morning it'll complete. So $100 off the Vanguard Consumer Discretionary Exchange Traded Fund. It'll give you some information about the order. So this $100 effectively buys 0.3 off the share, so a third, which makes sense because the share is 300, so a third of it is 100 and something. So preview order is going to say that the market is closed, which we know that. You can buy, of course, shares when the market at any time of the day. It's just that the price will change before your eyes if you do it during the day, and you don't necessarily know what the price is going to be tomorrow either, but it usually is within some range of what it was the previous day. So all you have to do is hit submit order, and then you have purchased your first share of hopefully some index fund, which is usually the better pick. All right, guys, so hopefully you have a better understanding of investing and how to get started. Of course, this is not a comprehensive guide to investing, but it should be able to get you started. You can sign up for any of these accounts in a matter of minutes. You just have to make the leap and get it done. It's always hard to get something started, but once you get it started, it's effectively easy and can be very well automated. So in terms of your 401k, 403b, that's done every month. HSA, same thing. Your contributions are every month automatically from your paycheck once you set them up. The Roth IRA, you can set it up to go through monthly or however often you want to. So you can do a lump sum at one point in time, or you can just do all of it in the beginning and not worry about it for the rest of the year. And same thing can be done with the brokerage account. You can set up automatic investment to set amount, any amount of money, usually every week, every month, whatever you would like. So you just have to pass the, the hump in the road to get to investing, but I can tell you that it is absolutely worth it. I have been investing now since I started my career effectively, and it has paid off. I have a bunch of videos about investing in little bits and pieces, so I will put that information up for you if you want to get a little bit more insight into how I think about investing and what it has done for me. If you haven't seen already, I managed to save $500,000, and that is mostly due to investing. So definitely recommend, if you do, well, you have to do some other things before, like I mentioned. You cannot just invest and not have the rest of your finances in order. But the one thing that I suggest you do for your finances once you have the bare minimum in order is to invest. Of course, leave questions, comments, or anything like that in the description or in the comments below, actually, and I will see you in the next video. Bye-bye.